Good evening, investors. Welcome back with me, Madhveshwari, on KleverStock, serving you the latest updates for the closing bell this evening. Kicking it off with the evening updates from Bursa Malaysia. Bursa Malaysia saw a sharp decline by mid-afternoon on Monday as the FBM KLCI fell 40.08 points to 1,677.98. The benchmark index gapped down at the opening and continued to slit as investors moved away from major banking and healthcare stocks. The overall market mood was grim, with nearly 1,200 stocks losing ground compared to only 255 gainers. Heavyweight banks took the biggest hit, with Maybank dropping 30 cent to 11 ringgit 46 cent and Public Bank losing 13 cent. Consumer giants were also among the top losers as Nestle tumbled 3 ringgit 80 cent and Fraser and Neff shed a 1 ringgit 40 cent. Despite the broad market slump, the energy and plantation sectors managed to buck the trend due to rising oil and commodity prices. United Plantations led the gainers, jumping 1 ringgit 32 cent, while Hibiscus Petroleum and Petronas Chemicals also recorded significant gains. On the broader market, almost all major indices, including the financial services and technology indices, ended the afternoon in the red. The local downturn mirrors a wider bloodbath across Asian markets as geopolitical tensions continue to spook global investors. Now for some local economic news updates. Prime Minister Datuk Sri Anwar Ibrahim has officially launched the fourth iteration of the Capital Market Master Plan 2026 to 2030, setting an ambitious trajectory for Malaysia's financial landscape to reach a valuation of up to 20 trillion ringgit by 2045. The master plan, spearheaded by the Securities Commission, outlines a 5-year organic growth target of 5.8 trillion ringgit to 6.3 trillion ringgit by 2030. This new roadmap is built on a 20-year horizon, focusing on 4 key pillars: vibrancy, inclusivity, sustainability, and regional opportunities. The initiative follows the previous CMP3, which helped the market expand to 4.3 trillion ringgit by 2025 despite the challenges of the pandemic. In this forward, Anwar, who also reserves as Finance Minister, emphasized that the CMP is designed a democratic wealth creation. He stated, "Through the CMP, we seek to position Malaysia as a regional leader in responsible investment, where ESG principles, Sharia compliant and instruments, and socially responsible investing are not peripheral considerations but bona fide investment propositions." A significant portion of the plan focuses on sustainability and digital transformation. The SC aims to mobilize up to 100 billion ringgit in cumulative financing for environmental and social projects by 2030. A figure expected to surge to 800 billion ringgit by 2045. To achieve this, the market will expand into alternative asset classes, including private credit, tokenized instruments, and AI-enabled advisory services. The document highlights a pressing need to raise the floor for the average Malaysian. Currently, individual participation sits at only 25%, with more than half of non-investors citing a fear of scams as their primary reasons for staying up on the sidelines. Furthermore, 60% of those not currently investing are under the age of 40, signaling a critical gap in financial engagement among younger citizens. The counter to this, the CMP outlines structural reforms and enhanced financial education to foster trust and lower friction costs. By strengthening regional linkages and liberalization the capital account, the SC expects to attract significant foreign participation, targeting assets with foreign underlying exposure to reach 110 billion ringgit by the end of the decade. Still on economic news, second Finance Minister Dato Sri Amir Hamzah Aziz assured the public on Monday that Malaysia's economy is on a solid footing and remains resilient enough to absorb the impact of the intensifying conflict in the Middle East. Speaking to reporters, the minister highlighted that the domestic oil and gas supplies are currently stable with no expected disruptions to local energy markets. He further noted that the government has the fiscal capacity to maintain the subsidized price of RON 95 transport fuel at RM1.99 per litre for at least the next 2 months, providing a temporary buffer against the recent surge in the global crude prices. Amir Hamzah said Malaysia is a good economic position and has the capacity to absorb some of the changes stemming from the opening conflict in the Middle East, adding that the country's status as a net energy exporter helps insulate the domestic supply chain. While the government had previously signaled optimism about raising its 2026 growth forecast from the current 4.0% to 4.5% range, policymakers are now taking a more cautious wait-and-see approach. Amir Hamzah noted that while current fundamentals are favorable, a prolonged conflict lasting 6 to 12 months would require a broader reassessment of the national economic strategy. Despite the current stability, the minister urged vigilance. The government is closely monitoring the Strait of Hormuz, a vital maritime choke point where disruptions have already delayed hundreds of tankers and pushed global oil prices towards the $100 per barrel mark. Up next, we have some corporate updates. Gold prices faced a sharp correction on Monday morning, with spot bullion retreating to $5,130.94 per ounce by 0554 GMT. The safe haven asset, which had earlier tumbled by as much as 2% during the session, is under significant pressure from a strengthening US dollar and a dramatic surge in global energy costs that has reshaped expectations for interest rate cuts. The US dollar index climbed toward a 3-month high, bolstered by risk-off flows as investors seek liquidity amid the widening conflict involving Iran. At the same time, the yield on the US 10-year Treasury note rose to a 1-month high, increasing the opportunity cost of holding non-yielding assets like gold. Tim Water, chief market analyst at KCM Trade, explained, gold is on the back foot today despite the market tumult, with triple-digit oil prices boosting the dollar on inflation fears and scaled-back rate-cutting expectations. He noted that much of gold's gains over the past year were based on a dovish outlook for interest rates. However, with oil prices now creating fresh inflation risks, those expected rate cuts are no longer a certainty, forcing a repricing of the precious metal. The escalation of the conflict has sent crude oil prices soaring more than 20% to above $110 per barrel. Major Middle Eastern producers have cut supplies amid fears of prolonged disruptions to shipping through the Strait of Hormuz. This energy spike has caused investors to recalibrate their expectations for the U.S. Federal Reserve. According to the CME FedWag, the odds of the Fed holding rates steady in June have jumped to over 51%, up to 43% just last week. Geopolitical tensions reached a new peak on Monday as Iran officially named Mojtaba Khamenei as the successor of his father, Ali Khamenei, signaling a hardline stance in the ongoing conflict. The political transition, alongside the threat of wider regional war, continues to rattle global markets. While gold typically thrives in the times of chaos, the current dominance of the US dollar has the preferred safety play in the limiting bullion's upside. Other precious metals also experienced volatility during the session. Spot silver managed to hold its ground at $84.42 per ounce after an initial 5% plunge, while platinum edged down to $2,133.95 and palladium fell 0.9% to $1,610. And finally, wrapping it up with business updates. Bank Negara Malaysia's international reserves reached $128.3 billion as of February 27, 2026, marking the highest level the country has seen in more than 11 years. The 1.1% month-on-month increase was largely fueled by a consistent uptrend in foreign currency holdings and the strategic accumulation of gold. Kenanga Investment Bank Berhad noted that the reserves are at their most robust level since August 2014. Despite the headline growth, the reserve position's capacity to finance imports slipped slightly to 4.7 months, while the reserves to short-term external debt ratio held steady at 0.9 times. Notably, foreign currency reserves rose for the 11th straight month to hit $112 from $112.5 billion even as the market navigated net capital outflows. Kenanga IB stated in its research report that net forex reserves climbed to a 44-month high of $79.5 billion in January, reflecting a smaller predetermined short-term drain. Gold reserves also reached a record $6.1 billion, likely due to a new round of purchases after B&M increased its holdings to 1.36 million fine troy ounces in early 2026, the first significant jump since late 2018. The ringgit has mirrored this strength, appreciating for a fourth consecutive month in February. The currency gained 3.0% against the US dollar during the month, with the exchange rate averaging 3.91, the ringgit's strongest performance since April 2018. This surge was contributed to a weakening US dollar as investors adopted a sell America sentiment and markets recalibrated risks following shifts in the US trade policy. The note added, conviction in the US dollar remains fragile, pointing out that the replacement of the International Emergency Economic Powers Act with a flat 15.0% risk of a sharper trade war. While Kenanga IB maintained its end 2026 target for the ringgit at 3.95, it warned what the currency has undergone a structural decommodization, meaning may no longer definitely benefit from high oil prices. Looking ahead, analysts expect B&M to maintain the overnight policy rate at 2.75% throughout the year, citing manageable inflation and a resilient domestic economy despite external geopolitical volatility. Well, that's a wrap for Closing Bell Updates with me, Madhvishwari. Thank you, investors. We shall catch up in the next session. Goodbye.